The smart money always moves first, quietly, almost politely, while headlines still scream prosperity. They read tape, not tweets. They sense stress in spreads, not speeches. And when the crowd hums lullabies about "this time is different," they start packing lifeboats. Tonight, we'll decode that pattern. The signals before the storm, the exits no one sees, and the plays insiders repeat in every era, from 1929 to .com, 2008, 2020, and what's brewing now. Taxi drivers giving stock tips? Cute. Your barber offering AI calls? Run. Late 1920s. America vibrates. Radios, autos, consumer stocks moon. Everyone borrows to buy more. Margin stacked on margin. Shoeshine boys trade tickers. Boardwalks buzz like trading floors. But beneath the champagne fizz, spreads widen, insiders sell, and the Federal Reserve tightens from 5% to 6%. That's the music slowing while the dancers don't notice. Joseph Kennedy trims. Bernard Baruch rotates to cash and bonds. Jesse Livermore builds shorts with monk-level patience. Crashes aren't moral judgments, they're math. When central banks tighten, leverage groans. In 1929, call money costs rise. Today, you see it in policy rates, bank lending surveys, and a chilly tone in credit desks. If money is oxygen, the Fed just turned the mountains into Everest. Smart money tracks funding first, because the bubble ends where the borrowing begins. Watch short-term rates versus risk assets. When they divorce, the parties filing for separation. Insiders don't ring bells. They file forms and sell discreetly. In 1929, corporate officers unloaded quietly for months. Today, clusters of executive sales near peaks whisper louder than headlines. Volume rises, price stalls. That's distribution. Professionals handing hot potatoes to believers. It's just profit-taking. Sure, and the iceberg was just ice. Before a break, markets wheeze. Indices make new highs while fewer stocks participate. Bonds firm as equities grin. Safe havens tick up, cyclicals cough. In 1929, bonds strengthened into the top. In 2000, old economy stealth rallied. In 2007, credit cracked before stocks blinked. When leadership narrows to a handful of darlings, gravity circles like a hawk. October 28th to 29th, 1929. Forced selling, margin calls, the liquidity death spiral. Livermore didn't guess. He mapped psychology, orderly exits, panic phase, capitulation. Baruch sheltered in bonds. Kennedy shorted the structure, not a story. Lesson: professionals scale out into euphoria and hedge the downside long before the first scream. I'll get out when it dips 5%. Famous last words. Different tickers, same script. Pets.com ads, no profits, Super Bowl swagger. Smart money watched. Rising rates, collapsing breadth, insider unlocks, and the quiet strength of defensives. They rotated to cash, value, and short baskets of no-earnings flyers. Housing peaked years before headlines. Subprime spreads widened, ABX indices cracked, repo haircuts rose. Stocks smiled, until credit dragged them underwater. Smart money shorted lenders, bought protection, and hoarded cash equivalents. The yield curve wasn't inverted, it was upside down screaming, "Buckle up." A health crisis collided with an everything margin trade. Funding markets seized, basis trades blew out, and forced deleveraging became global. The pros pivoted. Sell what you can, not what you want. Then buy what central banks explicitly back. The tell? Facilities with acronyms longer than your grocery list. Today's market hums with AI euphoria, megacap gravity, and geopolitical crosscurrents. Underneath, heavier debt loads, stickier inflation pockets, and credit jitters that flare, sleep, and flare again. Smart money doesn't predict dates. They handicap regimes. High rates longer, profits dispersion, and liquidity that's selective, not generous. Soft landing is finance for we hope the laws of physics take a nap. Phase 1. Euphoria with hairline fractures. Actions of pros. Lighten illiquid winners, trim crowd favorites, lengthen cash runway, build watch lists of quality to buy later. Hedge tail risks cheaply when vol is sleepy. The cheapest umbrella is always sold on sunny days. Phase 2. Distribution. Big hands sell into strength, headlines stay bullish. You'll see failed breakouts, weak follow-through, leadership narrowing, insiders filing Form 4s. Pros use strength to reduce bet size and raise dry powder. Diamond hands are great until they're paperweights. Phase 3. Funding wobbles. Watch short-term funding rates, credit default swaps, and bank lending surveys. Small cracks beat big headlines. Pros rotate to robust balance sheets, cash-rich compounders, and short froth where financing is oxygen. When financing whispers no, asset prices shout ouch. Phase 4. Gap down, vol wakes. The crowd calls buy the dip. Pros define rules. Don't chase first bounce. Let forced sellers reveal themselves. Scale only into panic price to over-pessimism. Knives falling look like bargains if you squint hard enough. Phase 5. Capitulation. Margin clerks run the market. Great businesses get tossed with junk. Smart money deploys playbook buys, quality at distressed multiples, secular winners temporarily mispriced, and barbell with safe cash. The best buys feel emotionally wrong. Insiders track where orders sit. Options positioning, dealer gamma, and passive flows shape intraday gravity. When gamma flips negative, swings expand. Pros choreograph entries around those tides. Markets aren't haunted, they're hedged. The edge isn't IQ, it's discipline. Systems over vibes. Pros pre-commit. Position limits, loss limits, timelines, thesis triggers. They survive to play the next hand. The crowd improvises. Pros rehearse. One rule separates winners. Cut losers fast. Forgive your ego slow. Smart money rotates, not just exits. Late cycle. Cash flow kings, pricing power, short duration projects. Early downturn. Defensives, balance sheet moats. Bottoming. Small caps with clean debt. Cyclicals with operating leverage. It's musical chairs. Own a chair. Price is a storyteller, sometimes a liar. Pros triangulate. Price plus credit plus macro plus positioning. One signal alone is gossip. Confluence is gospel. Next minute, 3 light checklist you can run weekly. Light 1. Credit. Funding rates, CDS, new issue reception. Light 2. Positioning. Options skew, sentiment surveys, insider activity. Light 3. Earnings. Revisions trend, margins, guidance language. 2 reds, reduce risk. 2 greens, add selectively. Mixed, trade smaller. Signals don't need to shout. They just need to agree. Kennedy. Exit early beats exit perfectly. Baruch. Bonds as bunker. Livermore. Plan the rhythm, not the headline. Post-2008 pros. Hedge liquidity, not opinions. Post-2020 pros. Buy what policy backstops. Avoid what policy ignores. The next rescue always comes with a new rulebook. Hubris dies broke. Pros ask, what would prove me wrong? They size positions so wrong answers don't end the game. They journal, review, and refine. If your strategy fits on a hoodie, it's probably not robust. 1. Define your risk budget. 2. Decide which regime we're in via the 3 light checklist. 3. Write entries, exits before the open. 4. Use alerts, not hope. 5. Hedge when vol is cheap. Buy quality when fear is dear. One mistake ruins decades. Over-leverage. Stories soar. Cash flows pay. Pros separate tech adoption, real, from profit timing, uncertain. They model unit economics, not vibes. Total addressable market. Everyone with a pulse. Okay, Sparky. You don't need prophecy. You need process. Enter in thirds, exit in thirds. Let price confirm thesis, not ego. Respect monthly levels. Ignore minute-to-minute noise unless you're paid to. The bottom never feels like one, because it isn't until later. Anti-fragile portfolios benefit from chaos. Barbell cash plus convex hedges plus selective growth. Own solvency. Rent speculation. Roller coasters are fun. When you're the operator, not the passenger. Sometimes the smartest move is boredom. When signals conflict, shrink size. Cash is an option that gains value as prices fall. Pros treat inactivity as a position. Next minute, the 4 words that save lives and portfolios. I don't know yet. Pros love them. They buy time to gather data, avoid FOMO taxes, and wait for confluence. The crowd craves certainty. Consilience pays better. Uncertainty isn't a bug, it's the paycheck. What could break next? Geopolitics, commercial real estate, stealth consumer credit stress, or an AI capex hangover? You don't predict, you pre-commit. What to trim, what to hedge, what you'll buy if prices puke. Final minute, your crisis oath. Repeat after me. I will not marry narratives. I will not worship leverage. I will cut fast, review faster, and buy only what I understand at prices that forgive mistakes. I will prepare in calm to survive in storms. The smart money isn't smarter. It's earlier, stricter, and quieter. Now you are too. Subscribe, stay sharp, and move before the music stops.